thank you very much, everybody, for joining. My name's Mark von Grundher. I'm a director of Benham and Reeves, and I'm based here in London. And I'm pleased to be joined today by David Smith, who's been the economics editor of the Sunday Times since 1989. Wow, that's over 30 years. He writes a weekly column. He's also a leader writer, an assistant editor and policy advisor. And since 2016, he's been writing a weekly column for the Times, where he also worked from 1984 to 1989. And he's an author of a lot of books, including The Rise and Fall of Monetarism. He's a visiting professor at Cardiff University and Nottingham University, and he's won a number of awards, including Financial Journalist of the Year. So I think we're in pretty great hands for an overview of what Mr. Sunak did for us in the UK yesterday. And I'm also joined by my co-director, Vida Mera, who's an accountant by profession. He's our finance director, and he's been with the business for a long time. And he's our resident tax and finance expert. So again, he's going to be here at the end with myself and David to answer any questions you've got. We've already got quite a lot of questions before the event, but we're going to answer as many as we can. So please do answer put any questions you like through the question and answer section, and then I'll get round to doing them. Just before David starts, for any of you who don't know Benham and Reeves, we are a estate agents. That's a lettings and a sales agency based in London. We've got 19 branches in the UK, with another one to open next year. But we also have branches globally around Asia, the Middle East, India, South Africa, helping clients there, whether they want to buy, whether they want to sell, whether they want to furnish. We offer a pretty all-encompassing one-stop service, including doing tax returns as it happens. And we're always here we do these kind of webinars to advise clients and help them with their decision-making and what they're doing with their portfolios. This is obviously our post-budget webinar, but we have them come up regularly. Our next one's going to be on the 8th of June, and it'll be a property roundup, but we'll send that out at the time. But without further ado, I'm going to pass over to you, David, so that you can give us all your in-depth analysis. Thank you very much.
Thank you very much, Mark. It's great to be with you here today, and good morning or good evening, depending on what it is for people. So it's good to be here. And you did mention I've been with the Sunday Times for more than 30 years. As I always say, I was only 15 when I started, but anyway, it's great to be here. And it's a good time to be looking at the property market and the UK economy after that spring statement, which is a kind of not so much a conventional budget, as the Treasury was very keen to point out, but it did sort of set the scene, and it gave us some important updates. So I'll talk about that. But what I wanted to do most of all is set the scene by answering these 5 questions, which are on the screen in front of you. I always adopt the principle it's easier to answer questions that you've set yourself. But I'm looking forward to your much tougher ones. So first of all, the housing market. I suppose one of the surprises of the pandemic has been the strength of the housing market, and it wasn't. Part of it was of course ultra low interest rates and the Chancellor's stamp duty cut, which we didn't hear anything about yesterday. But part of it was a kind of underlying momentum that was there anyway, and which I think continues now. Second, so what's the state of play for the housing market now? Can we have a continued recovery in the economy, in both globally and in the UK, in the face of the Russian invasion and other potential headwinds, including the cost of living crisis? So is that cost of living crisis, the surge in inflation that we're seeing, highest inflation rates in the UK for a very long time, is that going to last, or is it just a blip? Interest rates, we've seen rate rises in interest rates, three successive hikes in bank rate by the Bank of England. Is that part of a pattern? How much are they going to go up? And finally, the spring statement, what will be the impact of the measures announced yesterday? So taking those in turn, let me just give a brief overview of where the housing market is, I think, at the moment. This is actually a book on the illustration here is a book which is not, you'll be disappointed to hear about the UK housing market, but it was a thriller which was recently adapted for television. But anyway, it's a good illustration. Now, 2021, as you know, if you're trying to find evidence of what happened in the pandemic, there is not much of it in the UK. There's a brief period from March to May 2020 when the housing market was pretty much closed down, and the combination of that and expectations of a very severe recession, I think, led to a lot of conventional predictions that we'd see a crash in house prices. As you well know, that didn't happen. Instead of which, the market went from strength to strength, and it's probably one of the most unexpected mini booms in house prices that we've ever seen. This was not part of the playbook for the situation with the pandemic and the situation for the economy that we're in. But it has been a fairly extraordinary story. 2021 was an exceptional year, but if we look at what's and we ended with double-figure house price inflation, which continues on most measures. We still have house price inflation of 10% or so in the UK. Different parts of the country have had different experiences over this period, but you'll be glad to know that the London market has also woken up now and is showing decent rises, as well as the national picture for the UK. So double-figure house price inflation, so that wasn't part of the pandemic script that anybody expected. And transactions in 2021 were the highest since 2006, 2007, the highest since before the financial crisis. So again, there was catch-up in there, but even so, it wasn't just prices that were going up on the basis of a thin market. This was a pretty fat market that we saw since the pandemic, and lots of transactions and lots of activity. So all round a pretty strong market. And if we look at where we are now, I think, we know why there was that mini boom. The record low interest rate I mentioned, just 0.1%, as close as the Bank of England could probably get to zero for official interest rates. A total of 895 billion of QE has been unveiled, 450 billion of it in response to the pandemic. The stamp duty cut, the cut in 2020, in July 2020, was in response to a drop in transactions. And I don't think was so much targeted to helping the housing market in general. The great fear that Rishi Sunak had in 2020 was that the builders were stopping developing new sites, and he feared that there would be a really pronounced drop in new house building. So hence the stamp duty cut, but it obviously had a wider impact. More surprising in a way was extending it until last September in his March budget of last year. And again, what we saw was this phenomenon of people revisiting, reassessing their lives, reassessing their working lives, and deciding they're going to be working from home a lot more than they were before, changing their property priorities. And crucial to this too, I think, was what was the furlough scheme. We'd never seen anything like this before. If you're looking at for precedents for the furlough scheme, you probably have to look at something like the German Kurzarbeit scheme, which dates back, I think, to 1921. We've never done this in the UK, essentially paying people for not working as long as they were kept on by their employers. So we'd never had anything like that before. But once that was in operation, fears that we'd see 12 or 15% unemployment, which were around in the spring of 2020, quickly began to subside. So that was good news as well. And if we look at where we are now, this is the RICS residential market survey. Things that are above the line essentially are good. Things that are below the line are bad. Price rises continue to be very strong. So price rises over the latest 3 months, according to the RICS, remain very buoyant. The housing market is still strong, according to this by the Royal Institution of Chartered Surveyors, and so does buyer demand. You know, one of the characteristics of the housing market that I used to like to pick up before the pandemic was that you had a kind of an equilibrium in which buyer demand was relatively low, but also supply, you know, housing supply, and I'm talking about the supply of existing homes coming onto the market was also relatively weak. But at the moment, you know, and since the early part of the pandemic, buyer demand has been very strong, has been above the line. And as you can see here, you know, listings or, you know, supply, you know, vendor instructions, the supply of houses coming onto the market is also picking up, not as strong as buyer demand, and that helps explain why prices are rising so rapidly, but gradually picking up. So this is still an active market. It's a market in which prices are still rising quite strongly. The UK housing market is still looking pretty buoyant. And if you think of the backdrop to this, you know, a lot of people feared that when the stamp duty cut finally came to an end at the end of September last year, there would be a correction in the housing market. There was a brief fall in activity, but it was really over within a month, and both activity and prices have continued strong. We're into a situation of rising interest rates, but that hasn't so far deterred buyers. So this is a really strong and buoyant picture that we're still seeing across the housing markets at the moment. What about economic growth? I mean, without economic growth, the housing market needs a growing economy, I think, to thrive. We go back to January, then, you know, most forecasters, most think tanks were pretty upbeat about the continued recovery of the global economy from the pandemic. This was the IMF back in January, a strong picture, and you know, most parts of the world, most big economies were expected to have growth. You will have heard that the British government likes to boast that it has the strongest growth in the G7 among the 7 largest Western economies, and that was certainly true in 2021. Last year, as you can see, UK growth of more than 7%, admittedly following the biggest drop in GDP in 2020 since for a very long time. Originally, we thought that drop in 2020 was the biggest since the Great Frost of 1709. Now it's only the biggest drop since 1921, but still, you know, it hasn't happened for a long time. But in return, growth last year was the strongest since 1941. So you know, a strong bounce in the economy, and that boast of strongest growth in the G7 was going to remain in place for this year. It appeared, you know, we're going to continue to grow strongly in 2021, but that's, you know, that is subject to what's the situation that we've got at the moment, which is, you know, the Russian invasion of Ukraine. That has reduced economic growth somewhat, and will do so further, according to the IMF. There's not much evidence of a hit to growth so far, I should say. Just this morning, we've had what's called the Purchasing Managers Survey, Purchasing Managers Index, which has come out, and which shows that the economy in March was still pretty buoyant. This month is still pretty buoyant, so yet to take a big hit from that. But the IMF, which produced those forecasts at the start of the year, thinks it will have to revise global growth forecast down because of the impact of Russia-Ukraine, particularly the impact of higher oil and other energy prices. If we look at you know, what's happened to the UK economy, you see on this chart, this is monthly gross domestic product, monthly GDP, the extent of that decline during the first lockdown in the spring of 2020. Now, a big decline in economic activity in GDP for the UK used to be thought of, if you go down 2 or 3% in a quarter, that's a big decline. The biggest post-war decline before the pandemic was in 1974, the 3-day week, when we saw GDP fall by 2.7%. This one in the second quarter of 2020 was almost 20%. So off the scale in terms of previous experience, but also getting back quite quickly. Normally, it takes 3 years to get back to a pre-recession level of economic output of GDP. After the financial crisis, it took 5 years. This time, it's happened in 2 years. So pretty quickly back to where we were before the pandemic struck. Business confidence, businesses were really pretty upbeat last year. As you can see, the vaccine rollout was very positive for the UK. We saw, a big increase in business confidence because of, people thought then and businesses thought then that we were through the pandemic. And then towards the end of last year, the Omicron variant and then rising costs, rising inflation started to bear down on business optimism. So confidence dipped a bit, but it's picking up again now, and so is reasonably strong. Consumers are considerably less confident. They are quite worried about things. The consumer confidence, this is a measure that goes back as far as the 1970s, and often consumers are downbeat, but they're quite downbeat at the moment because of the rising cost of living. I think that is the main factor which is hitting consumer confidence at the moment. We might see another fall in this, I think, as when we get further evidence later this week. So consumer confidence is pretty weak in the UK, and there's good reason for that. I mean, one of the details that we had in the spring statement was a statement from the Chancellor of the Exchequer, Rishi Sunak, but accompanied by a new official forecast from the Office for Budget Responsibility, the fiscal and economic watchdog that provides the independent forecast for the economy. And as you can see here, one of the eye-catching things they described was that after allowing for higher taxes and inflation, real incomes will fall by more than 2% in the coming 12 months. And that's the biggest since records began in the mid-1950s. So a big hit. And you think of some of the crises we've been through since then, the first OPEC oil crisis, the financial crisis of 2008-9, and so on. This is this is quite a big event in terms of the hit to real incomes. And the question arises, why should we expect any growth in consumer spending? Why should we expect there still to be an appetite among households, among people to buy houses, when they're taking such a hit in terms of their real incomes at a time when taxes are going up, etc.? I mean, one reason for that is that the job market is very buoyant, very buoyant. Unemployment, fear of unemployment, key indicators for the housing market. At the moment, the number of people on payrolls, the number of employees, is well above pre-pandemic levels, and as you can see here, is rising quite strongly. So that is a big positive in terms of the economic impact on the housing market, that there are jobs for people who want it. Unemployment, there are many prime ministers and chancellors who would have given their eye teeth for an unemployment rate of less than 4%, which is what we've got now. I remember talking to Rishi Sunak about his furlough scheme. As I say, we'd never seen anything like that before in the UK. And he thought, when he launched it at the start of the pandemic, that if you could get through the pandemic and keep unemployment relatively low, but you wouldn't prevent it from going up somewhat. And he never defined how much somewhat would be. But if you could keep it relatively low, it would have been a great success. But to emerge from the pandemic with an unemployment rate identical to the one we went into the pandemic with is pretty near miraculous. And we've got an unemployment rate of less than 4%, which again is very supportive, I think, for the housing market, as is the record number of job vacancies. Some of you who read the Sunday Times and will have long memories may remember a time when we had, pages and pages of executive appointments in the Sunday Times, a 24-page section, a 28-page section, a 32-page section. Sadly, although you won't be sad about this, we don't have that anymore, because most appointments of all sorts, executive and otherwise, are made online these days. So we've lost that source of advertising revenue, and that may explain why it's easier to post appointments these days. But even so, 1.3 million plus job vacancies in the economy, as many vacancies as there are people unemployed, is the sign of a very tight labour market. We have a very tight labour market, which again is good for underlying spending in the economy. So the question, I mean, I think it's the central question about the economic outlook. You know, will people keep spending when will their appetite for housing continue when they're being squeezed so hard by rising inflation and rising taxes? And one reason for that, of course, is the job market, which I've just mentioned. A second reason is that most people, and I should say most forecasters, think that the rise in inflation is not going to be long lasting, that the squeeze on real incomes will be temporary rather than something that's going to be around for a very long time. But also, you know, left over from the pandemic and from the lockdowns and from the other restrictions is what economists would call involuntary saving, 200 billion of those, which you know, arose from a period where UK households couldn't spend on the things they normally spend on. You know, you think of the things we normally spend on, you know, eating out, entertainment, foreign holidays, even transport, even commuting. You know, commuting takes a high proportion of the household budget up, but when people couldn't do that, they obviously saved instead. I mean, there was a switch online to spending, but there were certain things you couldn't do online, and that accounted for a lot of normal household spending. So the involuntary savings build up. So this cushion and the strong labour market will, I think, see us through the worst of this cost of living squeeze. Or that at least is the hope that we've got. What about COVID? You know, some parts of the world, and some of you may be in those parts of the world, we're seeing a very strong rise in cases at the moment from Omicron or the Omicron variant. In the UK, on the right-hand side there, you see a little bit of a rise towards the very end there. But I think we can be still reassured that, you know, hospitalizations and thankfully deaths that were associated with Omicron were a lot lower than in the case of previous variants of COVID-19. So I think we can still hope for the best on that. And the big picture in terms of the economic outlook is one that, you know, economic growth is not going to be quite as strong as was hoped. You know, the OBR, the Office of Budget Responsibility, revised down its forecast for growth this year from 6 to 3.8% yesterday, but it's still pretty strong. It's still in the right direction. The recovery is, you know, if you compare the latest forecast, which is the blue line on this chart, with the previous forecast, which was made in October, which is the yellow line, you can see the economy's grown a little bit more rapidly in recent quarters than the OBR expected a few months ago, and will grow a little bit more slowly from now on, but not markedly so. This is still an economy that is recovering from the pandemic, and that has to be, I think, positive news. It's tempered, of course, by the rise in inflation. The latest UK inflation figures show that we're up to 6.2% on the main measure of inflation, which is the CPI, Consumer Prices Index, and you know, the target for that is 2%, so well above that. For those of you who prefer the Retail Prices Index, retail price inflation is currently running at more than 8%. So a big hit to inflation, a big increase in inflation that we're seeing at the moment. And it's general. You know, UK inflation is very similar to the European Union average, very similar to that in Germany, a bit higher than France, lower than in the US, where it's 7.9%. These are similar measures of inflation. So when the government and the Chancellor say this is an international phenomenon, you know, for once they're not spinning a line. It is absolutely true that this is an international phenomenon that we're seeing at the moment. Business costs, you know, the raw material and fuel costs for business are rising at about 15% year on year. The charges that the businesses are setting are rising at about 10% year on year. So there is more inflation in the pipeline at the moment, more to come in terms of higher inflation. We're not at the peak yet. And that is reflected in the new official forecast that we saw yesterday. Back in October, I mean, it's interesting how much of a surprise this has come to policymakers, both in the Treasury, the official forecast, the OBR, and also the Bank of England. You know, back in October, and that's, you know, we're talking about just a few months ago, the OBR expected inflation to rise, but average 4% in this year, in 2022. Now it expected to average 7 8.4%, so much higher, almost double, and for it to peak at nearly 9% at the end of the year. Now, previously the expectation was that we'd see a peak in inflation in this spring, and then it would ease off quite markedly towards the end of the year. Now, because of Russia-Ukraine, we're seeing these twin peaks in inflation and a rise again in the autumn. So some time to go before the inflation eases back. But as you can see, they do expect it to ease back. They do, and this will be reassuring to the Bank of England, which has a 2% target, that they do see it easing back towards that target over time. And pay growth, that just reinforces the point about falling real incomes. Pay growth is rising at about 4% year on year. For people who change jobs, it's always worth thinking about. I don't want to encourage people to be unduly, footloose, but people who change jobs generally achieve annual pay increases of about 9%. But for the majority of the workforce, which doesn't change jobs, pay increases are running at about 4% at the moment. So considerably below where we already are on inflation and where we're heading on inflation. But, without being too Panglossian and too optimistic about this, the forecasters expect this inflation period to be quite short-lived. It will be around for this year, it will subside next year. And I think there are good reasons for that. The history of energy price spikes, we've seen a number in recent years. There's one in 2008, just before the financial crisis really hit hard, when the oil price rose to an all-time high, but $147 a barrel. That subsided very quickly in the crisis. There's another one in 2011, when the global economy was emerging from the financial crisis, but that didn't last very long either. And I don't think, despite Russia-Ukraine, this will last all that long. I think markets tend to adjust, and I think the energy market will adjust again. Russia-Ukraine has complicated the second factor here, which was the easing of supply chain difficulties. But I think we can still expect those difficulties to begin to ease as time goes on. Again, markets adjust. The bigger issue, perhaps, than Russia-Ukraine in terms of supply chain problems is, the policy that China has towards COVID, which is its zero COVID policy. The fact that lockdowns are still occurring in China, blockages at the ports and so on. So that is a bigger issue in terms of supply chain difficulties. But I do think they will ease. There's not going to be a wage price spiral of the sort we were used to in the UK in the 1970s. And for those of you, the QE, quantitative easing by the Bank of England, has been a big factor, perhaps behind the strength of the housing market over the past couple of years, but also in the rise in inflation. If you don't have to be a monetarist to think that if you expand the money supply by 450 billion as a result of QE, it's going to have an effect on inflation. But QE is at an end now, and QE is being replaced by another acronym, if I can inflict that upon you, which is QT, quantitative tightening. The Bank of England is starting to reduce its balance sheet. It's done that by about 28 billion just this month alone. So that has gone into reverse, and that gives another reason to think that over time that will bear down a little bit on inflation. So, several reasons there to think this is not a new period of extremely high inflation, but it will subside over time. What about interest rates? On the screen there is a real dog who does bark, but the interest rate dog to channel Sherlock Holmes hasn't barked very much in recent years. We've been used to very low and very stable interest rates. But more recently, just over the past 3 or 4 months, you've seen the Bank of England spring into action on interest rates. Now, it has raised rates 3 times in successive meetings, and you have to go back quite a long time for the last time that happened. The Bank of England was given independence, was given control over changing interest rates in 1997 by Gordon Brown. And in that period, we saw 4 successive increases in interest rates. The first was by Gordon Brown, who was Chancellor, and the next 3 was by the Bank of England when it was given independence. So 3 in a row by the Bank of England has not happened since 1997, almost a quarter of a century, but it's done it now. I mean, you will note there that it's only taken bank rate back to where it was before the pandemic at 0.75%, so 75 basis points. But it is still, and it's important also to note that official interest rates are still historically extremely low. As I sometimes point out to people, the Bank of England has been around since 1694. Bank rate has been around since then. And it was only in the early part of 2009, during the financial crisis, that the bank rate fell below 2% for the first time ever. That through wars, through previous pandemics, including Spanish flu and so on, through other events, the big wars of the 19th and 20th centuries, bank rate remained at 2% or above, usually above, because it was thought that a lower rate, would be damaging to the banking system. We've seen lower rates since then. Since the financial crisis, we haven't seen a bank rate above 0.75%, above 0.75%. We are, I think, going to see it now. So I think we will go into new territory, or new post-crisis territory, in the coming months. I think there will be further increases. I don't think the Bank of England is going to be aggressive about this. It will be also watching what the Federal Reserve is doing in America, and the Federal Reserve has also signaled several rate rises to come this year. So I think we'll get back to 2% over the next 12 to 18 months. I don't think they're going to go much higher than that. I don't think we're going to go back to a pre-financial crisis level. From the early 90s to the financial crisis, bank rate averaged 5%. During the 1980s, it averaged 12%. I don't think those levels are going to come back, but I think we will get to 2% or so. And the reason it's 2% or so rather than 10% or so at a time we've got high inflation is because most of the factors pushing up inflation are outside the bank's control, and most of the factors that reduce inflation will be not because of things that the central banks do, but because of the energy market, geopolitics, and so on. So I think we can be reasonably reassured that we're not going to see a return to the extremely high rates of the past, which I think the economy and the housing market would find very difficult to adjust to. What about the spring statement? This is what we're talking about. I'm going to be perfectly honest with you. Mark and I talked about this beforehand about whether they would, would he give us a surprise cut in stamp duty? Would there be anything else for the housing market? It was actually, in terms of direct impact on the housing market, it was relatively thin gruel, I think. But those days are somewhat over. The 2021, the first year in which the Treasury thought we were emerging from the pandemic, was a record year for deferred tax increase announcements, tax hike announcements. So, corporation tax is going up quite dramatically from 19 to 25%. David Cameron and George Osborne, targeted reducing corporation tax. This Boris Johnson's government's gone in the opposite direction, increasing from 19 to 25%. Income tax allowances and thresholds frozen for 4 years. Again, Cameron and Osborne, their priority was increasing those allowances and thresholds by more than inflation. The big one, the national insurance hike, up, from next month, 1.25 percentage points on for both employers and employees, with a view to paying both for the NHS's pandemic catch-up and eventually for social care, though I don't think it will fund all that much in terms of fixing the social care problem. So 2021 was all about announcing tax hikes. The spring statement was all about announcing tax cuts. So one tax cut was a reduction in fuel duty. Now, some countries have gone really much bigger on this in response to the rise in petrol and diesel prices. For example, the Irish government announced a 16 or 17p reduction in petrol duty, slightly smaller on diesel. Other countries have gone bigger. I think the reluctance to go further from the Chancellor was because he didn't want to get stuck with a much lower level of duty. I think he recognises that once you've reduced it, it's going to be quite hard to put it back up again. So that was why it's quite modest. Raising the national insurance threshold, is a tax cut, which is worth quite a lot. and was a good reform. Was perhaps the best thing in the spring statement. So you before this you had this messy system where people started to pay national insurance at one level of income, £9,000 or so, and then they paid income tax as well at a higher level. Bringing those two into line has made sense. And then this oddball announcement of a penny off the basic rate of income tax, but not coming until 2024. I think just to show that he's not really all about tax increases. He is a tax cutter at heart. However, despite that announcement, which is factored into these figures, before this spring statement, the assessment from the OBR was that the tax burden, the taxes as a percentage of GDP, were going to rise to their highest level since the early 1950s, which is the yellow line here. On the latest assessment is that they will now rise to the highest level since the late 40s, which is, again, a Labour government, the post-war Attlee government, not something that a Conservative Chancellor would necessarily want to see as his legacy, highest tax burden since then. Now, a lot of people say to me, well, surely that has to be wrong. I remember much higher rates of tax than this. I remember when the top rate of tax was 83%. I remember lots of taxes being much higher. But of course, people, that's the beauty of stealth taxation. A lot of things that people remember are, they forget that VAT wasn't always 20%. At one time, it was 8%. National insurance at one time was 5% or so. Now it's going to be 13% plus. So, the tax increases that people notice less are the ones that have increased quite a lot. There's quite a lot of stealth taxation coming through in the freezing of income tax allowances and thresholds. So that's why the tax burden is going up. And of course, corporation tax is going up in quite a pronounced way. So it is real. It is genuine. I think he would like to, Chancellor would like to have more tax cuts in his locker before the next election. So maybe, watch this space for that. But that is the picture as it is at the moment. One positive, again, I mentioned the importance of the labour market for the housing market, and again, we should take comfort from this prediction. And forecasts aren't always right, but it is quite something for, the green line on this chart is what the OBR, the official forecaster, expected before the pandemic. The blue line is what it expects now. And as you can see, although unemployment did go higher for a while, its expectation is that it will chime in pretty much exactly with what it expected before the pandemic. And that is pretty miraculous, really. And low unemployment, as I say, is supportive for the housing market. So that, I think, is pretty good news. House price inflation, strong at the moment, as a 10% plus. Now, as you can see, this is not a forecast for the housing market. I mean, most forecasters make the mistake, including the official forecaster, of underestimating the strength of the housing market and of house price inflation. But even if this new forecast is right, it expects house price inflation to come down from 10% or so. Maybe at the low point will be, 1 to 2%, but then picks up again. So this is not a horror story for the housing market. In fact, it is a reasonably positive story. And similarly for an affordability, because of that easing back from 10% house price growth, affordability on this measure, the house price earnings ratio, does improve a little over time. It's still much higher than it used to be, but people used to think that the sustainable house price earnings ratio for the UK was 3.5 to 4 rather than 7 to 8. But things have changed over time. In general, interest rates are a lot lower. You have more double income households providing the earnings now than they used to support house purchase. So affordability will improve a little bit over coming years, which is good news. And although transactions this year will be lower, a little bit lower than they were in 2021, there are good reasons for that. Transactions rose enormously in 2021 because of the catch-up and because the extension of the stamp duty cut, I think, was unexpected by a lot of people. But over the medium term, as you can see, they expect the turnover to be in line with its long run average, rather than, pre-pandemic it was a bit lower than that average. They think it will revert to long run average. So plenty of activity to look forward to for Benham's and everybody else, I hope, in the coming years in the market. And so I think, I'm just pulling together what I've been saying here, is that I think the housing market is still pretty well supported in the UK. So the low unemployment I mentioned repeatedly. When you've got times of uncertainty, as we have at the moment, housing is widely seen as a safe haven for good reason. If you look at what's happened to the FTSE 100, over the past quarter of a century, at the end of 1999, the FTSE was just below 7,000. Today, it's 7,500. Of course, you've had returns over that period, dividends over that period, but in terms of the index level, it is barely higher than it was almost a quarter of a century ago, whereas house prices are 2 or 3 times higher than they were then. So it has been a safe haven over a long period. Interest rates, as I mentioned, are not going to surge. They are going up, but they're going to remain historically low. I think we're seeing a return to more normal times, the return to the office, and that's helping the London market at the moment, and will continue to do so. I mean, there was a shift away from part of the London market, in particular the flat market. Flats without balconies weren't very popular during lockdowns and other restrictions, but that is changing now, I think, and my colleagues on this call will confirm or deny that. And also, if things did turn down, then this is obviously something of a trigger point for this government and this Chancellor, as they showed with previous interventions, notably the stamp duty cut that we saw during the pandemic. So I think, overall, there's still a lot of support there, basic support there, even in these uncertain times for the market. And just finally, I'll update you. I've given you lots of economic indicators, probably too many there, and housing market indicators. I'll just give you one more, just to fill you in on my own proprietary economic indicator, and one other, which is the known as the skip index. I've been monitoring this for many years. It's based on a number of builder skips in my street. I've been following it for many years. The way it works is that when there are none at all, there's no growth, or we're in recession. When there are 2, we're growing in line with what economists call trend growth. And when there are 4, it's an unsustainable boom. And it's a good measure, not just of confidence in whether people are doing things, but also whether people are moving house. Because, as you know, one of the first things that people often do when they move into another house is to hire a skip to get rid of some of the stuff that the previous occupants have left, or to do some early rebuilding. And the other measure I've been monitoring during the pandemic is what I call the station car park indicator. And the station car park, about half a mile from where I live, is a station car park which takes people into central London. During the lockdowns, normally that station car park is full to bursting, 100% full. During the lockdowns, it got down to about 10% full at best. Certain essential workers still had to travel in for work purposes. Then, as things opened up in 2021, it got back perhaps to 50 or 60% capacity. At the moment, it's running at it's not quite back to where it was, because I think people are still doing hybrid working, partly working from home, partly working in the office, but it's back to, 70 to 80% of normal. So that has to be quite good news. And as for the skip index, I mean, it's been all over the place during the pandemic. When the pandemic first struck, we had the first lockdown, there were no skips in the streets, which fitted in with that calamitous decline in GDP. People weren't confident enough to want to have work done, and they certainly weren't confident enough to allow the builders anywhere near them. But then it picked up quite strongly as the sort of working from home revolution got going. People wanted loft conversions, conservatories, and all those things. So at times we had more than 4 skips in the street. It really was booming. But I can say that we've settled down now. We're at 2 again. So I'm not saying that all is right with the world, but a degree of normality has returned, which I think can only be good news. So thank you very much for listening. I look forward to your questions. Thank you very much indeed.
That's amazing, David. Thank you very much. Gosh, there was an awful lot of information, and I'm glad David was worried his internet might drop, and I'm really pleased that didn't happen. I would just say there was an awful lot of information in that, because obviously, as you can tell, David is the expert. You know, economics is his thing. We are going to send copies of all of the slides. So I know a lot of people have asked, are slides coming? 100% tomorrow. It'll pop straight into your inbox with a copy of the presentation today and a recording of it if you want to go through and listen to what David said again. I would say that we're not giving a market update today because that's for another time, and we wanted just to focus on the budget. But I did just record one with Vanessa Warwick at Property Tribes where I talked about where the market's going. So I'll include a link within that, within the slides that we send out afterwards. But I must say, it's quite interesting what you said, David, about the tax cuts coming. So I think we've all got fingers crossed there. And the other thing is the two new indices that I've seen is the skip index. It's always good to see lots of skips. I just don't want them outside my house because that means I'm spending money on works, nor next door because it drives me nuts with 5 o'clock deliveries. And I also think the car park index is quite interesting as well, because we've seen an awful lot of, you know, people coming back into the market. That's why the rental market's so strong. So we've got a few questions. I think Vidas, you're still with us, right? And I think the first question I think is quite interesting that was asked before is, what's everybody's view on how the 2022 property market's going to pan out? And kind of secondary to that is, why are property values still increasing? And that's both in London and the UK. Maybe, you know, do you want to have a stab at that first, David? You know, what's the view? Where's the market going to pan out, and why are they still increasing?
Yeah, I think as I touched on, several minutes ago, probably half an hour ago, a market is the housing market has its unique characteristics, but markets are driven by supply and demand, and we're still in a situation where property and desirable property is still relatively scarce. I think there are more buyers than sellers, and that continues. So even though more listings are happening, I pass a lot of estate agents' windows where every property in their window pretty well has got a sold sticker on it. It is there is still unrequited demand there from people who would love to buy and who would love to and are not able to because the supply is not there. I mean, I think my colleagues in the business are sometimes guilty of emphasizing only one source of supply, which is new build. The more important source of supply, which keeps the housing market going, is the supply to the market of existing homes. Homes that have been built, in some cases hundreds of years ago. But if they are not coming to the market, then there is a supply-demand imbalance. But I think it's that, and I think that the one positive thing about the interventions that the Chancellor did, which particularly the stamp duty cut, but also very low interest rates, is that they established a momentum which has carried through. And I think that there is no sign yet of that momentum easing back. So I think it's a combination of momentum and supply-demand imbalance, which will keep property quite strong. I don't think we're going to see double-figure house price inflation for the full year. I think it will ease back to perhaps about 5% by the end of the year. But I think things are still going to remain pretty strong, as is activity. So that's my view. Yeah.
Yeah, no, that's great. Vida, have you got a point? Have you got a thought on that? How it will pan out and why they're still rising? Or,
well, I mean, what I would point out is that we've been through quite a lot over the last few years. Of course, the pandemic still very much in our minds at the moment, but we can't forget that we went through a lot of uncertainty with the Brexit negotiations, which took a lot longer than we expected to be agreed. And so for quite some time now, several years, people have been a little bit worried about what's happening in the housing market. And dare I say it, right now, it looks like we're in a much more positive time period with a lot of those uncertainties now having been dealt with. Of course, you know, the war in Ukraine is a European crisis, and that's going to have implications as well. But personally, I think that we're actually in what I'd say is a golden time for housing, for the housing market, and all those people who've been worried about those uncertainties and what's going to be happening are now going to be looking at making a move that they previously put on hold. So that's going to push those supply constraints up and have a positive impact, I believe.
No, I think that's a very valid comment. I think in both of those things, I think interesting what David talked about secondhand property and how we all focus on new build. You're right. And I think what you've seen is, you know, during COVID and to some extent with Brexit, there was a lot of uncertainty. People were moving out of London, and that is why London prices trailed. But we are now seeing, as David talked with his car park index, people don't really want to sit on the train for hours, and they realize it's very far and they miss the London life. So you are seeing people coming in, and that's why they're renting. And I think that's going to be a big driver to the market. So my view on where the market's going this year is I think we will definitely see 5%, if not 6% growth. A lot of pundits are saying 4 to 5%. I think it'll go above that because you're going to see things reopen and people start to come in. So Vida mentioned on the Ukraine thing, it's an interesting question, and a lot of people keep asking this. What's the panel's thought on the sanctions on the Russians? Is that going to really affect the prime London market? David?
Well, I suspect you're in a better position to answer that. I think, you know, if you, the thing about the sanctions was that, you know, we gave, the UK government gave everybody, including probably Roman Abramovich, time to sort things out before that. I mean, I think if you are, you know, certain types of property were, you know, were tailor-made for oligarchs, but oligarchs aren't the only rich people in the world. You know, there are still many attractions to having a base in London. It is, you know, it is a truly international city, and I think if anything, you know, the uncertainty that we're seeing globally at the moment, the geopolitical uncertainty, increases the attractions of a city like London. So I think you know it's going to be you know, 6 of one and a half dozen of the other, that it will, you know, there may be an effect, but there will be replacement purchases, I think, top end.
I agree. Vida, do you have a view on that?
All I would add to what David has said is that there are very few properties, when you consider the market as a whole, that are going to be affected by these sanctions, and certainly not enough to dent the market in any way. I think it's important that as a country we are seen as transparent and stable, and that's one of the reasons many people own their homes in London, and people invest in property over here. And so it's only a good thing that we are focusing on making sure that continues.
No, I agree totally. I mean, there are lots of stats about here. Transparency International estimated that Russians own £1.5 billion worth of property in the UK, and that's obviously primarily focused on London. £1.5 billion, yes, it's a large amount of money, but it is only £1.5 billion in a £1 trillion market. So the effect is very limited. That's my view. And we, honestly, as a business, we have very few people from that region, and none of them are exiting. And as you said, Vida said on the sanctions affect very few. So honestly, I don't see any effect. I think this is an interesting question a couple of people asked, is about how damaging will high short-term inflation be on the market, on the property market, not the stock market, on the property market. David, do you want to take that?
Well, I think it's you know, it's again, it's a slightly two-way thing. I think it generates the uncertainty. I mean, but the inflation, as long as people think that this is going to be temporary, as I said, and this is not the new era we're in. If you know, there's a difference between people thinking that I'm being squeezed, my income after taxes and inflation is going down a lot, and that's going to be the picture for the next 10 years, to them thinking it's going to be the picture for the next 12 months, you know. So as long as people don't think that the inflation cat is really out of the bag, I think it will have a marginal effect. I mean, I was saying to some people the other day, you know, it's almost as though the housing market is a bit of an island in this uncertainty, you know, that and I think there's a certain element to which that's true, that the home buyers, you know, they don't suddenly, it's not like buying a shirt or a new mobile phone. I mean, home buyers are built up to the moment in which they want to transact, and they, you know, it's not a whim, it's something they've been thinking of for some time, and it's got to be something quite dramatic to put them off that journey, I think. I mean, it's you know, they and often, you know, that journey will have meant looking for the place they want for quite a long time because of the supply shortages I talked about. And again, are they going to say, well, inflation's a bit high, I don't think we'll do it now? You know, if it's the place they want, if it's at the price they want, I think the impact of high inflation is going to be quite marginal on the housing market. And of course, when you've got higher inflation, you're also looking for something which is quite a good hedge against it, and the housing is a good hedge against inflation.
I agree. I think that, Vinod, do you want to talk on that a bit?
Well, I think the one thing that we need to focus on is the correlation between inflation and interest rates. And of course, a significant increase in interest rates could have an impact. But I think everyone in the industry and various think tanks are all predicting along the lines of what David was saying in terms of what the predictions for interest rates are going to be. Slow increases for sure, but not to the very high levels we've seen in previous decades. So, you know, the market can sustain a bit of an increase, and, you know, we can expect that, but I don't think it's going to have go up to levels that are going to make an effect on the market in general.
I think I was going to ask a question on interest rates, and maybe I'll just come back to that. I mean, I agree with what you both said. Actually, but it is a good hedge. Remember, property is a fixed asset. When all the quantitative easing happened and inflation goes high, the fixed assets increase in value. So, you know, it's a very good hedge. Interest rates, where do we have a view on where we think they're going to go? I think, David, you touched on it, but I don't know where you think it's going to be by the end of this year. Maybe going to go up over the next couple of years.
Yeah, as I say, I think the end point for this tightening cycle will be a bank rate of 2% or so. Maybe we'll get, 2.5%. Markets think it will be 2%. That's what's priced into the money markets. You could go a little bit higher than that, and I think some people would welcome that. You know, it's not these are not sky high levels. One of the mistakes I think the Bank of England made between the financial crisis and the pandemic was not using the opportunity to raise rates when they could have done, when the economy was quite strong in 2014, 2015. And that meant that, when the pandemic struck, they had to consider and add to their toolkit the possibility of negative official interest rates, which would have been very strange indeed. I know, the European Central Bank, one of its official interest rates went negative and still is. But it's not a comfortable thing to do. And raising rates to not particularly high levels, but still levels which permit some kind of reduction is quite good. And in combination with this, unwinding some more of the QE that it did during the pandemic would be no bad thing, I think. And I think it's unhealthy when the Bank of England owns 40% of government debt. That should not be the situation we're in. So I don't think they're going to frighten the horses or frighten the housing market, but a gradual move to 2.5%, I think is what I would expect. Only if things got really out of control, and they haven't got out of control for a very long time. And 8 to 10% inflation looked as though it was going to be sustained would we break out of that? But I say I don't think that's going to happen.
Good, Vida, do you have a figure in mind? Because we're going to run over time a little bit, but go on, and I've got a couple more others.
No, I fully agree with what David's saying. You know, if I was to make a bet, I would say, you know, increases up to 2.5%. Possible. Anything more than that, I think, would probably be a stretch. I think that you know, developed countries have kind of evolved into this norm of a low interest rate environment, and the way we see things in Japan, for example, is that becomes a standard and you know, hovers, you know, maybe up to 2% and down to very low levels, but doesn't tend to go out of those boundaries.
No, I agree. I agree. And to be fair, even when the Bank of England base rate goes up, the actual margin on mortgages doesn't go up so much. So I think, you know, for repayment of loans, I don't think you'll make it uneconomic, and you know, I don't think we're going to see big interest rate increases. This is interesting. How easy is it generally for overseas investors to purchase properties in London? And the next question is, are international buyers returning? That's kind of a theme of a few people have asked that. I think that is quite interesting. I mean, Vida, do you want to take that quickly first? You know, whether international buyers are returning and overseas, how easy is it for them to buy?
Well, in terms of ease, it's always been very simple in terms of the process to purchase a property, even if you're not based over here. You engage solicitors to deal with your conveyancing. We, of course, will help guide our clients through the process, helping them find something to buy that suits them. And actually, our services range through the whole life cycle of the property ownership. So, you know, that can all be taken care of. And yes, as you would expect, with the easing of restrictions following the pandemic now being much more easy to travel, we are seeing lots of people come to visit, because a lot of people do like to see what they are going to be buying before they put their money down. And so with the opening up of the travel, we definitely see that translating into more demand.
Good, perfect. Yeah, I mean, it is very easy for overseas people. You don't even need to come here, and we can do everything for you. We can do videos, and you don't even need to sign the paperwork in the UK. In some countries, you have to physically visit. You don't here. It's very easy. It's very transparent. Anybody can get a loan, and your assets controlled. David, what do you think about international buyers returning? Do you think that's starting from an economic point of view? People starting to come back in now?
Yeah, I think so. As Vida was saying, you know, I think people were deterred when it was difficult to travel, because again, it's one of those things we didn't know how long those travel restrictions were going to be in place, and for a while, you know, the figures we've got now were suggest that the UK was not as relatively badly hit by COVID as we thought at the time, but. You know, there were lots of kind of plague island headlines around at one time, which I think perhaps deterred some foreign buyers, not being able to visit, seeing the UK as in the grip of something worse than other countries were experiencing was a narrative for a while. But that narrative, I think, has gone away now, particularly with since the vaccine rollout. And also, it's, you know, the removal of remaining travel restrictions, I think, is good news. So I think there is a return. I think there's an opening up going on in general in terms of, you know, we're still doing things like this, but, you know, business travel is increasing. Other forms of travel are going up, and will come back, I think, and that helps. I mean, as you say, it can be done from a distance, but people like to see what they're buying at some stage anyway.
Yeah, I agree. And I think they are starting to come back. We're seeing it now. So there have been a couple of questions around the whole thing between London and the regions. And I think we should look at that. You know, do you both agree or disagree that London versus the regions, that kind of split we've seen, will reverse, with London accelerating or not? And do we think that the trajectory that we've seen outside London will continue or will start to come off? Vida, do you want to take that first?
Well, what I'd say is that I don't profess by any means to have expertise in the property market outside of London. But from everything that we've seen, when you're investing in property, and if it is an investment, then what you're really looking for is something that's going to be safe, stable, and show a healthy return. And I think if you want to, if you want to lower your risk level, then London is always going to be the better option. That's what I would say, in my point of view.
Good, David.
Yeah, I think.
Are we seeing a reversal or not?
Well, I think so. Part of the reason why the regions did much better than London was that what normally happens, as you'll know, Mark, in the market, is that London tends to be first, and then other places catch up. And London did get quite a long way ahead, in the period post financial crisis, pre-pandemic. And then during the pandemic itself, London was relatively hard hit by restrictions and lockdowns. The furlough scheme, which I mentioned in the presentation, in which people were effectively kept in touch with their employer even though they couldn't work for them. The areas of the country with the highest proportion of people on furlough, 9 out of those top 10 areas were London boroughs. So many people in London boroughs were furloughed, a higher proportion than the rest of the country. The other area, the 10th area with the highest furlough proportion was the area around Gatwick Airport. So so the London and the southeast suffered, had a bad pandemic experience. And in the case of London, it was mainly because that whole kind of economy associated with people traveling into work, commuting, everything, all the jobs that were supported by that, for a time went into abeyance. So that's why London suffered. But those things that is changing now. Sometimes people ask me, and I think there is the London market and would I expect to see London prices rising a lot more than prices in the regions over the next 12 months? No. Would I expect them to be similar? Yes. Sometimes people ask me, what about levelling up? Isn't this all about taking, wealth and economic activity away from London to other parts of the country? And in general, it's not. This government is not, it's not like sort of post-war governments which deliberately tried to move investment away from the southeast and the West Midlands. It would like to do more infrastructure spending in other parts of the country, but London's had quite a lot of it. I mean, a lot of, some of it hasn't quite been completed on time, as you'll know, like Crossrail, but we can expect it to open quite quickly. But London has had a lot of that spending, and it's not going to end there. Government ministers, and Rishi Sunak is an example of this, is quite good at describing any form of government spending as levelling up. He recently went on a visit to Faversham in Kent, which, as you will know, is quite a long way from the northeast of England, and he described something that the government was doing there as levelling up spending. So it doesn't have to be miles away from London to be regarded as levelling up. And the one thing the government won't want is to see the London economy decline. And the London economy is one of the great strengths of the UK. It has productivity levels of enormously higher than the rest of the country. So it's got sectors which are integral to the London economy, which are some of the most competitive in the world. And there's not many regions of the country that can say that. So London is an essential part of the UK recovery story. So I don't think we're going to see anti-London policies from the government.
Good. Well, I mean, my view is actually, I think the outside London has had a much faster trajectory than London has because of the reasons you mentioned. And I think as workers return and people realize how far they are away from home, from the office to home, I think, and they realize the cost of travel, I think you're going to see those people coming back in. We're seeing them renting. I think they will end up selling in the country and outside and moving back into London. So actually, I think, not saying the regions will suffer, I think that will just put more pressure on the London market. So we are a little bit over. So let's answer one final question because it's a fun question. So if you had a London property now, Would you hold it, sell it, or sell it and buy another one? That was something someone asked the other day. I think it's quite interesting. David, do you want to do that first?
Yeah, I would hold it, and I've got one, and I'll hold it. So I'm not looking to buy at the moment, but I'm happy to hold.
Good, Vida?
I think I would agree, but what I would say is that I am more tempted now to sell than I have been previously. Previously, it was a clear hold, but now with the market actually very buoyant, and I think it will be. It does make you think a little bit.
It's interesting because I think property is a fantastic long-term investment, and I think it's a great hold. But I think it's a reasonably interesting time at the moment if you want to buy something slightly larger. I think this is a reasonable time to be trading up. So actually, if you've got a one-bedroom flat and you think, actually, I've got a little bit of cash on deposit, I think to sell that because the market's relatively strong and buy something larger is relatively strong because prices have not started to move up. So actually, I think it's not a bad time to trade up. What you don't want to do is trade down, and you don't want to exit the market because you'll never get back into it. And I think that's a shame. So we're gonna round up now, and I'm so pleased that so many people have stuck with us through the whole of this presentation. I hope you've really enjoyed it. Thank you so much to David for that fantastic in-depth economic cycle and insights into what the Chancellor did and the economy in a whole. Thank you, Vida, for your help as well. Our next webinar is going to be in this kind of property roundtable series we're doing, will not be until the 8th of June, where we're going to have another panel with some experts, tax advisor, lawyer, mortgage broker, the head of Rightmove Data, and a couple of other property experts are going to join. If you'd like to join that, we'll send it to you. As I said at the beginning, a copy of today's presentation, the slides are all going to be sent out. A lot of people have messaged asking for that, and it will be sent out. And so once again, thank you very much. David, Vida, thank you very much.
Thank you.
Thank you.
Thank you very much.